Many of you are surely wondering why I have summoned you at this hour.
It's time for the big interview.
All right, boys, prepare to be dazzled.
That's right, it's big. It's the big names, the big news, the biggest stories. It's the next big thing. What's the big deal? It's the big interview.
What's going on here? This is big news. We need coverage of this.
Money Life brings you the big thinkers, the top experts, the brightest minds. With the big interview, you can stay informed about all the financial matters that are important to you, all in one big package.
Oh boy, I've never gotten a package this big. I've always wanted to have a huge package.
Did my taxes pay for this?
The big interview. Sit down, strap yourself in, and get ready to learn.
Your mind is beginning to work. It's entirely due to my inputs, of course. You mustn't take any credit.
Well, today we are hoping we're going to get your mind working around a subject we don't spend a lot of time talking about here on Money Life, and that is commodities. Because, well, spring has sprung, and that means that people speculating on commodities, it's full bloom. And that really does happen. Like, it's springtime, so we're going to speculate more about commodities. Here to discuss commodities, what you might be thinking about, and how he sees the market is Howard Marella. He's president of Icon Alternatives. If you want more information on the firm, it's iconalts.com. And as long as you're doing that, well, it's easy to remember their Twitter handle because they're at Icon Alts. Howard Marella, welcome to Money Life.
Thanks for having me.
We are at that spot where, people's attention is turning to spring and what spring means. And in the commodities world, spring is not about love necessarily. It is about market conditions and certain things. So for you, when you look at the market conditions right now, is there something to love, or is it just the seasonal usual stuff?
Well, no, it is something to love because we've got a new look on how people are going to invest or trade in exports, in grain, et cetera, overall. The grain market itself would be part of an inflationary environment, which could very well happen under the new Trump administration and all the incentives that should be coming out. There's going to be a big mix and a wide variety of how trade will be set. Grains themselves at this time of year, usually because of the weather, is where the volatility comes in. Speculation as to planting, growing, et cetera, begins to start up heavily at this time. If the dollar being strong and grains holding their ground, at least for the time being, is pretty good. It's a good sign. We could have equity price inflation and commodity price inflation all at the same time, and that's obviously because the Fed has been trying to push the inflationary button for years now, and it's time to take off. The issue is going to be very much on trade, international trade, alongside all the weather markets and the speculation and hedging going on with the farmers buying grain, selling grain. Crude is a huge part of the equation right now, too, and we're talking food and energy, which is really the driving force here.
Well, and the energy picture has got to be interesting because we've had a winter that, at least in my neck of the woods in the Northeast, has been warmer than normal. But then you get to the summer, which is it going to be a big, busy driving season? And early travel picture things suggest it will be. So, right, those two things play into it. Is it a point where we're going to see oil prices start to push back up, crude prices push back up?
Well, yes, it is. I think overall we're going to have higher levels of crude. We've just recently pushed our levels from a one range to a higher range, but there's such a tug of war going on in the crude. I mean, energy has been in the news for a lot of different reasons. You have the cyclical issue with more driving, more using more energy for winter, for heat, or even for cooling in the summer. That's always in play, but you've got OPEC on the outside, jawboning the market higher, saying that they're going to cut production, which they are, but holding Iran and Iraq to that deal is a whole other story. They're going to sell out the back door. When we've got a potential for a lot more production in the U.S. right now under the Trump administration and being able to drill and push the pipelines, et cetera, that's going to bring more supply in. So there's a big tug of war. I think that the levels are going to stay up, but we're going to get more supply down the line, several years down the line. This isn't a near-term thing. Mm-hmm. And we've got to start looking longer term on a lot of these markets. Everybody's gotten used to short-term trading, and not just in stock market, but in commodities and everything. Trends are going to continue. We're going to see some big cyclical trends because there's things happening in the world right now. There's a lot of things happening, and we're going to look back on these days and say we should have known that crude would have done X or grains would have done Y. And these are the things that we've got to set ourselves up and put some strategies towards.
When you talk about putting strategies towards something, for the average investor looking at commodities, commodities are that classic alternative play. They're not stocks, bonds, real estate, and cash. But
correct,
we now have the ability to play them by using ETFs. Is that the smarter way for the average person to do it? I mean, I certainly can wrap my head around the corn ETF or something along those lines a little bit more easily than I can trying to trade contracts myself. But is that the way most people should be looking at commodities?
No, and there's a reason for that. It's easy to do the ETF because it's part of your stock portfolio. Our biggest challenge is education, which is what we do with our clients. We try to make sure that they're well informed on what they're doing, how to invest, and the difference between the two. ETFs is just an index on the market itself. It's not the actual commodity. When you invest in commodities or trade commodities, you're doing the physical commodity. It is corn, it is wheat, it is beans, it is crude. It's not an index on that market. They have to come into our market and buy or sell based upon how many they do with those ETFs. So in actuality, they are trading ours, but it's not a direct, pure market for it. And a lot of those ETFs, if you're talking gold ETFs, you're getting gold mining stocks and a bunch of other things too. It's a completely different contract, and it will lag behind, or it might change or be illiquid. You can get better leverage in ours. There's a lot of things that you can do with ours that you can't do in ETFs, only because it is the pure commodity.
I know, talking to investors, that the commodity idea intrigues a lot of folks because they want to be able to add that juice. They want to get the alternative asset class and something that's not correlated. I just know that they're a little bit afraid that if they step straight to trading commodities, they've gone all the way to handling a power tool that they're not necessarily trained at.
That's the thing. It's education. People don't know or understand commodities enough. In the past, we've had our reputation as too risky. Outside of, if you take a look at what's happened to the stock market in recent years, it's not any riskier than the stock market. It's how you trade it. You don't have to be in full throttle in the futures industry. You don't always have to buy the futures contract outright. There are option strategies that are fairly simple that anybody can be involved in, and that's hedgers. That is just a simple investor, a regular guy who wants to open up an account and say he thinks that grains are going to rally or grains are going to drop. They're not hedging, they're not doing anything, but they just want to invest. If they say, hey, look, okay, I want to buy corn, I want to be long corn because I think ethanol is going to really take off, and that's going to be an issue, and we're not going to have enough corn because farmers are planting more beans this year, and this is the year for ethanol. Well, what they can do is they can go in and we can set up a strategy for them depending on their risk. But just like anything, you don't just go to an investment advisor and buy stocks out of nowhere. You have to say, this is why. This is why we're doing this. This is why what we're investing for. This is the risk. This is the reward. A lot of people have gotten used to just going online and playing stocks like it's a video game. And that's not the way to do it. It's not the way to do it long-term with stocks. It's not the way to do it long-term with commodities. It certainly isn't the way to do it long-term with commodities because, yes, they're risky if you don't know what you're doing.
We sit here today with inflation on the rise and interest rates going up. I try to think about commodities and I go, okay, well, as a general rule, prices going up, inflation, and interest rates going up, is pretty much good for all commodities. Like I try to think about what would be the one that it's not good for, and there aren't many that are out there. Does that wind up creating a false positive in terms of this market? I mean, I know you're optimistic, but is there more danger out there than there appears when you just kind of think about, wait, those conditions are normally ripe for things to be going up?
They are normally ripe, but we've been ripe for a long time. It's just that they haven't let the economy go. There's been an albatross on our shoulders for a long time, and I'm not just saying personally. I'm talking about the economy itself, here, overseas, everything. And it's been held down for a lot of different reasons. It's an outlook, I think. It's consumer confidence. It's all those things. Investors are going to start coming back in because they have to. Interest rates probably aren't going to run high real fast. They're going to stay lower, although we'll find out on Wednesday, depending on what the Fed's going to do, if they're going to really start raising rates or not. It's going to be in small amounts. That's what I think. But that's a good thing. The rates being low is normally good for all commodities or all trade because you can borrow money at a cheap rate. But they've been tight on lending. They haven't lent. Now that the banks can make money, they'll lend money. This is what we're looking at. So there's a big. It comes full circle as to whether it's going to continue one way or the other. The commodities themselves, if the dollar stays too strong, well, it's going to hold commodities down. If the dollar gets a little bit weaker, or say some of the Europe strengthens up again and it balances itself out, then we're going to continue with the bullishness across the board. And it's time. It's time for this inflation. You look back years from now, you're going to think that all this was a low price level.
Well, Howard, great stuff. It's time for my audience to think about commodities, and it's time for us to go. Thanks so much for joining me on the show.
My pleasure.
Howard Marella is president of Icon Alternatives. For more information, iconalts.com, on Twitter @iconalts. Money Life will be right back. Stay tuned.